This is episode 57 of the More Doors podcast. We are here to talk about the current state of the banking world. I'm here with my very intelligent, very handsome co-host. We'll be back with the show right after this. All right, everybody, we are back to the More Doors podcast, episode 57. Nick, Brian, what's up, boys?
What's up?
57. It's good to be back, boys.
You got that robot arm over there. I like it.
You like that? Yeah.
I didn't know you could just elect to take your arm off and put a robot hand on there.
It's like the new thing.
Yeah.
Yeah, it's like a cyborg. All right.
The 21st century, bro.
As soon as like it melds better, I can pull a Terminator and like rip the skin off and show you my cyborg hand.
I made this comment on a show a long time ago with my friend, Michael DeBacker, friend of the show. And we were talking about the future of medical technology. And we were also talking about the current state of like mixed martial arts and things like that. And like nowadays, like we're grown men, so we don't get in bar fights and things like that. But you do have to be careful in today's society because you don't know who's like a trained fighter walking around out there.
True story.
And these guys know how to do holds and chokes and all these things. But in the future, it's going to be like you need to not mess with people because it's not about MMA. You don't know who's half robot and has like a cyborg arm and would just choke you to death at a Denny's because you popped off.
Powered
like
by AI.
100%. 100%. It's going to get real. There's a book by Yuval Noah Harari called Homo Deus, and it's all about the future advancement. I firmly believe that the first people that could medically live forever have already been born. Doesn't mean you can't die from anything. You get hit by a bus, that's going to take us a little while to solve.
They were on the podcast.
God.
And the award for the most awkward intro to the show goes
Yes.
to Brian Forrest.
Yeah, he did it yesterday too.
Did he?
Yeah. It wasn't an intro. It was more of the middle and the end.
It was basically the whole show.
Yes.
What's happening, gents?
Man,
Other than your, Yuval Noah Harari quotes.
he's a great writer.
I know.
It's good to be
Sapiens.
back. It's good to be back.
Yeah.
It feels... Yeah, Homo Deus was the sequel to Sapiens. It feels great. It's fall. College football's on.
Yes.
Whenever the seasons change this time of year, I forget about all the chaos in the world. It just feels good to step outside in the morning with that crisp air, the smell of burning leaves, and Notre Dame is playing a trap game this weekend, and it's just everything's right in the world.
Which is better than not 103-degree heat.
Way better.
True
No
story.
one-
Significantly better.
Yeah, you don't want to walk out the door and you're already sweating.
Yeah.
You have to go back in and take a cold shower. So,
Don't worry about World War III starting, but
yeah, I don't know if we want to talk about that. Other
Yeah,
than
that's crazy.
Maybe today, just all the looming bank failures that are still potentially happening.
Choose your own adventure.
Yeah.
But before we get into either topic, why don't we give a nod to our sponsors?
Yeah, the best one is Deep Blue. Deep Blue Capital. Look, if you're needing to invest money, right? Maybe you got it in a bank that could be going under and you want to get it out really, really fast, which we would recommend. You should look at getting with Deep Blue Capital, deepbluere.com. Sign up for the investor newsletter. And when you do that, you'll get a call from me.
The bear.
Yes. Yeah,
The
it's really
Bears.
bad right now. Like all this is, I need a haircut. The beard needs to be trimmed.
They have products for that, dude. You can hide the grays.
I don't care. I love the gray.
Yeah?
Yeah,
a little
Heather,
salt and pepper.
Heather loves it.
Does she?
Yeah. I've seen people, dye the beards. It looks weird.
It does.
Yeah.
it looks really weird. And you can definitely tell.
Yes.
Definitely.
Yeah. Look, I go all natural.
All right. So for those listening, Nick does not dye the beard.
I do not.
All three of you now
yeah.
know.
And when you sign up on deepbluere.com, I'll FaceTime you. That way you can see. So, whether that gets you to sign up or not, but you should take a look at it. We've got some, we're actually underwriting a lot of great deals right now, a lot of opportunities that are coming down the pipeline. So, if you've got that opportunity, you got some funds that you need to go place, let's talk. Let's have a conversation. And then you need to do a podcast like this with this Tor Studios, torstudios.com. And Jesse Showalter, who is the voice with no face, he'll get you hooked up. torstudios.com.
Just trying to find
Word.
the number.
Actually, before we dive into the show, we've been saying this at the end of the show the
I know.
last couple of
Yep.
weeks. We're going to do it at the beginning of the show. We need some reviews from
Please.
our loyal listeners out there. Go to YouTube, go to Spotify, Apple Podcasts, leave us a review. Send us a screenshot to office@deepbluere.com. That's going to go right to Mr. Force's mailbox.
I don't know if today's the day we should be asking for reviews in the beginning with such a
too late.
rusty open.
Too late. Send us a review, screenshot a review to us. We'll send you a great Deep Blue Capital hat, little swag as we continue to build out the community.
We do have them.
We do have
Matt doesn't believe us sometimes.
No,
but
I
we
definitely
do
don't
have
because
them.
I still don't have mine.
I'll bring
I
the
wear
box up
my DBC hat every day.
I know you do. Both of you do. I've seen
I
the
would like
pictures.
one.
I have none.
It's the most beautiful
I think it was
hat
my
you've
idea
ever seen.
too.
It was your idea.
It was.
Thank you, Matt.
I'll bring the box up tomorrow.
Right.
I like hats.
$620 billion in unrealized bond losses. That's what I think we're up to.
Holy shit. You were going full blown Lego Batman today.
You know, it's funny. I don't know what it is. I got kind of sick after Vegas.
Yeah.
And everything about me recovered, but my voice, I still got sick voice.
Yeah.
I think you're
Feel fine.
I think you're just doing it on purpose.
You know how
this.
difficult it is to purposely talk with your voice low all the time, like Michael Clark Duncan? It's
Oh my
difficult.
God.
It's
You and the
difficult.
name references today.
That guy's super famous. Was super famous.
great
Rest in
voice.
peace. Stay hard.
Yeah.
Whole 9 yards.
Okay.
Green Mile.
Oh, him. Okay,
Yeah.
got it. Yeah.
I don't know why I said the whole 9 yards before Green Mile.
He was in Ricky Bobby.
Yeah.
He was in
Don't put
Armageddon,
that
too?
evil on me, Ricky. But he's an Armageddon. See, you guys know Michael Clark Duncan.
One of the greatest movies of all time, Armageddon.
You know
It's up there.
what song I don't hate?
Oh boy.
It's a good song, dude. I like that song.
What?
From Armageddon, the
Oh,
Aerosmith one.
Oh,
yeah,
Aerosmith.
It's a
Yeah.
good song.
It is a good song.
We might have to re-record this show.
Yeah, totally.
Yeah. Please leave us a 5-star review. So how much in billions and bonds?
All right, so let's get to it. We had a historical series of events over the past couple of years. The fastest Federal Reserve rate increase in human history after a really long stretch of very low interest rate lending.
Free money.
Free money, right? ZERP, zero interest rate.
Zerp.
And now there's a whole lot of paper out there. It was written at 3 or even sub 3. There are bond yields on the back end of that. And there is a Fed lending rate, which they just made a 50-point basis cut, but that was the first in several years, and rates got very, very high. And none of these are adding up. If you look at like SVB, they attributed that bank failure obviously to the bond yields or the losses they took in the bond department. Right now, outstanding, I think at like the last statistic I heard, across most of the banking industry right now, there's $620 billion. I think Nick was the first one to tell me this, in unrealized bond losses. So that is absolutely an alarming figure. 2, you have a ton of regional banks, local banks. Okay, U.S. banks unrealized climbed in Q1. So that was in Q1.
Yeah, I'm going to see if I can find it.
Yeah. Anyway, so at the end of Q1, it was $512 billion. Now it's even higher. That's a lot.
Yeah.
Then you have most regional banks are going to put most of their money into the safest assets they possibly can. So things like commercial mortgage-backed securities, things like that, which obviously those are now trading at distressed rates. And so if I want to trade that paper out, I either need to sell the loan at a discount, which means I'm taking a haircut on the front end, which I probably don't as a regional bank have the solvency to do that for my entire portfolio, or I'm going to slowly watch my bond losses continue to mount until something happens. Either the Fed just cuts rates back to almost zero, where we started, which has all sorts of other issues attached to it, like inflation, or I'm kind of in a death trap right now. And I don't know I don't know what the outcome is from all of this, because I don't know that there's any real path to normalcy that doesn't involve at least some bank failures. And bank failures don't always mean the 2008 financial crisis.
True.
But it is an interesting time to be living on the back end of these moves by the Fed, the moves made before by the entire lending industry with very cheap and free money for a long time. It's the same thing as the housing market is suffering from an era of run up in asset prices because of very cheap mortgages. And then how quickly that came to a grinding halt, right? When the Fed started to raise rates. And most of that started in this era of free money middle COVID era money. And now we're living out the effects of it. And so I guess all I'm saying is I don't know how the banking industry plays out from here, but you can't have this type of monumental movement in policy without significant effects on the back end.
Yeah.
We're about to be rolling right into the back end.
True. And so we can talk about kind of the macro conditions, right? I think you did a very good job of communicating that. But, many, many moons ago on one of our first episodes, we talked about kind of the looming debt crisis, right?
Yep.
And we talked about rate caps expiring, valuations, and, bridge debt coming due and all that sort of stuff. And, I wanted to kind of put out there on the show that, I and some of my other partners, we're working through that like as we speak. And I think the problem is becoming bigger. So as valuations have dipped a little bit because of decompressed cap rates, rent growth stagnated, OpEx costs have gone through the roof, right? Valuations have come down and we're starting to see that, right? But we're also seeing that some of these bridge lenders may have been flexible before, but now they're starting to realize that they're looking over a cliff and they need to be a little bit more stringent and less forgiving. So as an example, right? We took out two bridge loans a couple of years ago. Properties were side by side. We acquired one in August, one in November. So it was an initial 2-year term, interest only, and we had 2 1-year extensions built into the loan agreement. Okay. Now there was some fuzz on the agreement about, the projects needed, construction should be complete, et cetera, et cetera. So last year we renewed where we exercised our first extension easily, right? So we come into this year thinking, well, the reason why we extended last year is because rates on agency debt were unfavorable. We would have been upside down on those deals compared to the rates that we had on bridge, and it just didn't make economic sense. We were performing, right? We continue to perform, no issues with the properties, etc. So we come into this year. 5 months ago, we get an email from this particular lender, and they say, please let us know if you're going to be extending or, you're extending. And by the way, if you do, your rate's going to be 11%. And we're like, whoa. Nothing has changed about us, the performance of these assets, right? The status of the construction projects, the whole thing. Why is it 11%? So we go back and forth with them. They send us an email in writing. By the way, most emails are in writing. Okay. And it says, good news. They've agreed to extend you at your current rate for an additional 12 months, contingent on proof of insurance and appraisal and something else brainless, right? No problem. So we go through, we pay for the appraisal, comes back exactly where we needed it to be.
Yep.
And a week before the maturity date, they call us back and they say, unfortunately, we can only extend you at 11%. A week before the maturity date, right? So I raise a shitstorm.
Yeah.
I'm sending emails to anybody who will listen. I get managers and directors on the phone, et cetera, et cetera. And this guy says, I understand your point. We came under scrutiny last year for giving you guys the extension without an increased rate. They won't let us do that this year. I explained the fact that we were knee deep in a refi.
Yeah.
And he says, okay, here's going to be my counteroffer adjudicating for you on your behalf. And we were aligned, right? They came back to us after 5 weeks of waiting.
Yeah.
They came back to us last week saying the executive committee declined your counteroffer, but they're willing to do this. And we basically got 90 days to get this refi done, but they're going to charge us 10.5% for the next 90 days, right? What we found out between then and now, in the last 30 or 45 days over there, they have completely reorganized the company, let a bunch of people go, right? And so I bring this example up as a point. Number one, the drama out there is real, right? But number two, they know something about their financial condition and the state of their book of business that is probably financially preventing them from giving grace periods like this to other investors. And you talk about bank failures, and I agree that there's so many unrealized losses on not just the bonds, but probably the assets too, right? And then you add this on top of it, and I think we're in for some volatile waters.
Well, and I want to jump to that because some of my assets I was going through, before I sold them off, I was going through the same thing of trying to restructure the debt. And, you know, I'm at a smaller regional bank that, sorry about that, you know, prides itself on relationships. And basically the same thing happened that you experienced, Matt. And then as I'm researching this here, and we're talking about the bank failure, potential looming bank failure risk that's happening, listen to this. So right now, 63 banks, as of 2024, are on the FDIC's problem bank list, meaning they're at risk of failure due to financial, operational, or managerial weakness. These banks hold a combined total of $821.1 billion in assets, with significant unrealized losses. Those are estimated around $517 billion, right? And this is due to high interest rates and exposure to commercial real estate loans. Now, that is an increase. The 63 banks is an increase in the number of problem banks from 52 that was at the end of 2023. So we're seeing this continuing to go up, and this is in part due to decline in the property values. Like I said, valuations are going down, right? Especially in the office and retail sector. So we don't know, you know, you're looking at you're the only thing you're looking at, but they're looking at the entire picture alone. And how much is that bank that you've got the relationship with, that you're asking for something? Well, they could be exposed in the commercial markets and getting hammered on that. And as much as they would like to extend that loan, and as much as it would make sense, because on paper it probably makes sense just to extend it. Right? Logically, you're like, dude, just give me this. Just kick it out a little bit more. We're performing. Why would we want to bump it up from X to Z? You know, it makes zero sense. But behind closed doors, they're over here having to restructure everything and trying to make up for those potential losses on paying clients like yourself or customers.
I mean, obviously, commercial and multifamily office and multifamily are different, but my gut is telling me that, you know, with them not really marking to market the asset value in a true way, which would uncover a lot more unrealized losses because asset values have come down. It has nothing to do on an asset specific basis, right? Like, you only being able to be renewed at 11% is most likely being punished for having a bit of a stabilized asset, and they go like, we can get these guys to renew, because they have to, and their asset's stabilized, they're not going to let it go, and that's going to make up for other distressed assets over here, right? If you're looking at an office building right now that you bought in 2021 on a sub 4% mortgage, not only are you not making any money on that paper right now, but the asset value has tremendously declined. So if you were to go sell that loan, you have to mark it down so much that you might be, if you had to do that for your entire portfolio, you'd be insolvent in the blink of an eye. And so they're trying to figure out, where can we get these renewals at, or these extensions at, percentage wise, that we can maybe go sell that loan and make up the difference. Because if it's an 11% loan, it's much more attractive to another investor than if they renew you at your current rate. And you extrapolate that to the office sector, nobody wants to buy office building loans right now, you know. And so if you have to discount the loan itself, you're taking a haircut. And so your best bet is to get the loan renewed or extended, but you got to jack up the interest rate a ton to make up for all the ground that you've lost. And that's why everybody's getting punished, because you got to make those moves across your entire portfolio and just try to get whatever juice out of the squeeze that you can.
Sure.
And unfortunately, performing assets like yours are getting punished.
And we're at the mercy of banks. Like,
Yeah.
you know, the whole point of More Doors podcast is about acquiring multifamily assets and building your passive income or residual income and you know, investment income through real estate and multifamily particularly. And we think logically that we have these game plans, like, oh, we'll go negotiate, like we can renegotiate with the bank. And maybe your banking relationship said that that was an option in the beginning. But there's, as I'm researching this, you know, one of the things they talk about for these high risk bank fail or potential bank failures is that one of their top goals is improving risk management. And they do that banks do that through strengthening their asset liability management through hedging instruments like interest rate swaps. Right? So basically they're swapping on you. Right? You're trying to ask for this extension and they're like, "Yeah, we'll do it, but it's going to be at 10.5%, 11%." And what they're looking to do is just restructure their books to make it better, and it screws the it screws the investor over.
Yeah. And I think there's actually probably a very distinct line of bifurcation between some of these bridge funds and actual FDIC insured banking institutions, right? Because look, nobody wants to relive 2008, but the government's already shown a number of times that they're willing to step in and put assets on their balance sheet at large scale, right? And I don't know if that necessarily needs to happen this time around, but I think the big difference between, and I continue to say this, between where we are now versus where we are then, don't sell, right? I mean, people that lost money in 2008, 2009, and look, I had friends who lost their pensions and their 401ks were down 60 or 70% because they sold, because they panicked. Right. And I think if we don't panic right now, this will work itself out over time. We've always talked about the kind of fact that real estate tends to be very forgiving, especially over time. We've just got to find a way to get through this, right? And see what happens with the new normal, right? We talked last time about, you know, the last two times the Fed dropped by 50 basis points and what happened to the economy. Those were very, very distinct black swan events. Right. We kind of even brainstormed this on one of our last shows. I don't see anything happening like that other than the Tinderfest that's happening out in the Middle East. Right. And hopefully that doesn't escalate any further. Right. But, you know, what is the trigger that's, if any, that would force these banks to need to liquidate rather than just weather the storm?
That is a good point. There's no real, there's no, from what I can see, there's no real threshold by which if you go past this, then everything fails. And that, I guess, insolvency, right? If you just do not have, if you take if you take such mounting losses in the bond department and you just literally run out of money, and you can't get enough new money into the system because rates are still too high and loans are just not being made at the same rate that they were, then you do eventually run out of money. That's going to be different for every single bank. Then there's also consolidation, conglomeration. There's ways to save regional banks and things like that. So there are moves you can make there, right? The financial crisis is a very obvious black swan in retrospect, right? Teaser rates expired. Millions of Americans couldn't afford their new mortgage. It all kicked off like a powder keg, you know? I think that's a really good point, is things will work themselves out over time for anybody who's able to weather the storm. And it is the most difficult times when you really should be in buy mode if you can stomach it.
Yeah.
But I do think there's going to be a lot of conglomeration in the regional banking sector because you only have so much liquidity and you'll have so many mounting unrealized losses that you can take before you just can't borrow any more money.
Agreed.
You know, and then you got to do something.
Yep. And I think this is a really good precursor and a really good indicator of the buying opportunity that we've told our audience we believe that there is right now. So there's another investor here in the area, very large outfit, and they just got a 3-deal portfolio that was non-performing directly from the lender. And they got to look at the deal because they had just done another deal with that lender a few months before, and it was fast and it was easy and they executed well, right? So as we start to hear about these banks that are on the distress list and all these hundreds of millions of dollars in potential unrealized losses and valuations changing and stuff, if that bank gets to a point where they have to liquidate, right, instead of turning the lights off, right, those assets that they sell are probably going to be sold to somebody on the cheap, right, for paper value, if not even, short sale status. And do you, as an investor or as a buyer, want to position yourself to be ready to handle those opportunities?
Well, those are the opportunities that you saw during 08, 09, and 10 is buying tapes of properties that were in foreclosures. The banks didn't want, it was a faster way to get them off the balance sheet.
Right. And they have to, because that is the choice that a lot of lenders are going to have to make. And that might be where the biggest buying opportunities are. If I've got a whole bunch of mortgages out there at 3% or whatever, my bonds are getting crushed right now because every time interest rates went up, those became worth way less. The money I'm making on that paper is nothing. But now I can't do enough loans quickly enough at a higher interest rate to make up for those losses. I can't go out and continue to lend at 7% quickly enough to make anywhere near the ground of the amount of loans on my book that I made between 2020 and 2022. It's just impossible. There's not enough buyers out there right now. And so in order to balance my portfolio, I'm going to have to do things like charge people 11% to extend, or I'm going to have to sell my non-performers at a massive discount and take a hit myself just to get them off of my books. And that's why a lot of those regional banks are in trouble and probably will have to consolidate and conglomerate and get together, because that's one of the only ways out of it for them, because they have so much low interest paper on their books and there's not enough deals being done at a higher interest rate. So that's where your non-performing opportunities are going to be. There's going to be a lot of opportunities, I feel, from banks that are like, we just got to get this off of our books. A lot of it's going to be office, unfortunately, and I don't really know that I want to go into that space, but there's going to be multifamily as well. You're already seeing it.
Yeah. And I think we even hypothesized about this last time we had this conversation, right? We've talked about the timing of the Fed cuts and quote unquote a soft landing, right? But is there motivation from the Fed to continue to cut to sidestep these landmines, right? Inflationary pressures aside, payroll pressures, jobs aside, payroll pressures aside, does the Fed have an MO to continue to lower, right, to save the banks that could be in distress?
I think they normally would, but if we run into like what's going on Iran-Israel conflict, so it could drive up the cost of oil, right? Because 20% of the world's oil supply comes from the Strait of Hormuz.
Gas is 45 cents today.
Yeah, and so then you throw in, so that could lead to inflationary pressures, right?
Yeah.
Then you throw in the port strikes.
Yeah.
And how long that could take.
Yep.
And now you're starting to see a drive up in prices that it's definitely more man-made on this than just normal, probably economic,
cycle
running of its course. Yeah. And so do they, in my opinion, do they cut on the next meeting, or do they hold off until December?
Yeah.
Just to kind of see wait and see approach. Yeah. And now it kind of throws all this into turmoil.
Yeah, it becomes a very pick your poison scenario, because if you continue to cut very quickly, you do run the risk of inflation, right?
Yeah.
And then you add to that what is happening in the Middle East. You do add to that the port strike, and now you have to make a decision. What's worse for the economy? A banking collapse, or banking, call it whatever you want. A banking crisis where you've got an inverse relationship between interest rates and bonds, and now a lot of banks are basically at the behest of the Fed, hoping they bring rates down to normalize things and hoping that spurs buying activity enough that they can balance out their portfolios. Or what is worse, that or 10% inflation and 6% unemployment within 18 months?
Yeah.
Which is entirely possible as well.
Yeah, I don't think they want to create the double swirl, right? And I think that all signs point to, in the absence of any sort of accelerant, right, them taking a slow and gradual approach to further cuts.
Mm-hmm.
I think everybody started to get really, really excited a few weeks ago when everybody was talking about the difference between a 25 and a 50 basis point cut the day or two before the Fed met. But I think they're going to take it slow and gradual. I think it's if they act with volatility, they will create more volatility.
Yep.
And that's the thing is they waited too long. The wait and see approach on that was a wait too long and then drastic measures. Here, the wait and see approach is not. It's not as it doesn't hurt it the way that the reverse wait and see. Right. You know, you had a run up in prices, inflationary getting out of control, and then you were trying to try to chase it down to catch up, and you had to do drastic measures. Then, now it's I don't think they should do one. Honestly, I don't think they should do one the rest of the year. Wait until first quarter of 2025.
I agree with that.
You know, let's let things play out, see what happens. You get through the elections and get a new administration in place, and then we determine, all right, where are we going? And what is on the horizon, and things will play out.
They'll play. You're going to see a lot of commercial real estate trade for really cheap. It's already happening, right? The Loop building in Chicago sold for $14 a square foot. You're going to see a lot of that type of stuff happen. I think what you're saying makes sense because I think the backstop is larger, more insulated banks that can absorb regional bank failures, right? If J.P. Morgan had $2 trillion worth of unrealized bond losses because they're the size of 50 regional banks, there'd be a lot more concern.
Yeah,
I think in the sector right now.
Right.
Unfortunately, my advice, and I think that we were just talking about this pre-show, and I think we need to go make some moves. Is you might want to get your money out of some regional banks right now, or at least have an idea
Please
of what's on their balance on your balance sheet, because I do believe there will be regional bank failures. I think it's simple math. I just don't think everybody's going to get out the exit quickly enough. That doesn't necessarily mean that the financial sector collapses. That does mean that a lot of larger banks probably absorb some regional banks for pennies on the dollar, and maybe the federal government has to step in and put some things on their balance sheet for a little while because we're talking about a lot of commercial real estate. But I think that is a much more manageable problem than if you start to see inflation get back out of control and then you see mass layoffs, you see all that type of stuff. That's where I think we run into real issues.
Yeah, I completely agree with you. And I think this is kind of part of the consolidation component of the market cycle, right? We went into a tremendous long period of prosperity, right? And now you're identifying some people, some companies in the market that may have made some bad moves, right? And they got to kind of go flush that out. But luckily, to your point, right, I think we have a very strong economy. We have some very, very solid players in the space that can make some acquisitions, can absorb some of this extra risk and feel minimal downstream impact to the consumer and the investors like us.
Yeah.
I just worry, the thing that, we think of banks as secure typically, and I go back to, all right, 2023, there was 52 on the list. Then it increased to 63. And the pressures haven't been released, right? So it's like a lot of it has to do with interest rates and then the commercial valuations and the commercial performance of loans. Yep. And you start to run into that, and it's going to take time to clear that out. And so if it was kind of a joke at the beginning with the sponsor, if you have money tied up and you should probably get it out and come invest and look at deepbluere.com.
Yep.
But it's not a joke because I'm going to tell you right now, I don't want to wait on the FDIC to give me my $250,000 or whatever's in there. Or if I have more than that, saying, all right, you're only getting $250, we'll try to recover whatever else is left. Like, I don't want to deal with that. Like, why would you want to run that risk if you have money and sitting in a bank or tied up in that's on that one of those 63? Why would you not try to look at something else.
Agreed 100%. And if you have the opportunity to partner with people that are on the train tracks for non-performing assets, now is when you need to be in buy mode if you are looking at deals right now. It's a scary time to feel, but that's the contrarian investor in me. Whenever it feels like it's the most tense is usually probably when you're making the best deals. When deals are easy, just give it a few years.
Yeah.
What does Warren Buffett say? When everyone else is running out, then it's time to rush in.
100%.
That's it.
100%. Well, boys,
Strap in.
strap in. We're here for the ride. I'm excited. Check out deepbluere.com for all of our upcoming offerings and partnership opportunities. TORE Tour Studios for all your multimedia needs. Please like, share, subscribe, leave us a review,
Send it to us and you get some swag.
and we'll give you a free hat.
Maybe Matt's hat.
Maybe we'll give you Matt's hat.
Maybe my shirt. Maybe both.
Yeah.
All righty, boys.
See you
Thank
next
y'all
time.
for listening. See you next week.